could've been a pimp, the way I move my lips. I be speed, could've been a drive, way I push the whip. You a hoe, could've been a bitch, the way you throw a fit. But fuck that, right back to the script, cause this a major league. He got bricks, plus his neck and icy, and it matches wrist, now it's like 6. Told her hit his phone, meet up in the whip, but he ain't go. But he ain't that slow, say meet him at the stove. I'm like cool, let him run his move, do what he gon' do, cause this the plot. Put him in a pot, let it cook like stew, I grab my Glock. It been through a lot, but it still shoot like Louis at the top. Yeah, we lost a lot, but that's just how it go, but check the scope. If y'all lose one more, that's 6 to 24. Let me focus, can't be zoning out. He pulling up now, he double park. He ain't getting out, he in the push to start. That new Porsche, it feel like a horse. Colors like the 4th, he got a ring, I guess he ain't divorced. Might probably a horse, now she walk up, she strutting her stuff. This bitch thick as fuck out in the truck. Kissed him on his lip, he cuffing up, but now I sneak up. Crouching like a tiger, like Snoop off the white, block on fire. So I take precautions, mask on Michael, man, I'm on his ass. He been up, be mad, he gon' beat her ass, but this what happened. I got to the door, I thought I was capping, I was lacking, cause they go to ops, yelling I was cracking. I'm like what? I'm like nigga who? I was born to shoot, I got aim, I'm like Johnny Dane, when it cut a chain. So I rise, hit one in his arm, hit one in his thigh, this no lie, bitches do or die. You say you gon' slide, you got some nerve, no shit on the curve, but we put in work from 64, and from 65th, we not from 63rd. We not from 63rd. Stress can't put in work.
Yo, guys, how we doing? Here we go. Should be live. Hey, we're up. How's it going, guys? Welcome to the stream. We are here today with VolaTim, Tim from Fink. And if you're new to these streams, basically on these streams, I like to meet other traders and understand their processes and understand their lifestyle and just really get to know other traders. But also learn something from them, which is kind of the main point. And I've got a lot of mutuals with Tim, and I've been looking, obviously, if you guys are following along, I've been looking at getting into the stock market. It's kind of probably the end goal for most traders. I think I've been trading FX since 2015, crypto since 2017. But I always felt like my future is going to be in stocks. So I've had people tell me to reach out to Tim, and yeah, here we go, basically. So I want to the main thing that I want to talk to Tim about is that he used to trade FX primarily like I do, and made a switch over to stocks, and said he wishes he did it sooner. So I'm kind of probably going to feel the same way at some point in time. But yeah, this is going to be a really good conversation, especially for anyone who's looking to get into stocks as well. Especially as crypto is kind of like dying, and people need to kind of branch out a little bit. So hello, mate, thanks for coming on, and nice to meet you as well, really.
Yeah, my pleasure, mate. I'm looking forward to this. It's been a long time coming. We've sort of chatted a bit online, haven't we, and sort of here and there, but we've never really kind of done anything like this. So looking forward to it.
Yeah, I'm quite bad at messaging and keeping up with people these days. Now I've had the kid and like I've got so much on my plate, and this is kind of like the best way for me to do so, really. So we're going to get straight into it. So the first chapter is teach me how you trade, and essentially we'd just like to know what your kind of process is and your outlook on the market. So when you get to the computer, when you're looking at something to trade, how you're looking at the charts, and then what you do to go from I'm looking at this to find an opportunity to execute in a trade, and what that looks like, really. So I've got your screen up.
You've got my screen up. Brilliant. Okay.
Yep.
So, I mean, the main thing that we're doing, all right, and this is, I think, something that's a massive, massive difference between FX and stocks, is trend following. All right. You can't really get, over a decent time horizon at least, a trend in FX most of the time. You get the odd exception, like dollar yen. You know, we have had a pretty decent trend in dollar yen for quite some time, but you get those moves all the time in stocks. And it's one of the reasons why I absolutely love stocks now, and sort of, I'm not going to say I hate FX, but you know, it's not far off. It's not far off. I've fallen out of love completely with FX now. And it's just because you've got the volatility built in. You know, it's. I mean, just look at the chart. Like this is Micron. I think everyone's been aware of the memory trade for a long time now. You know, and you've got stocks like Micron. You know, you can go right back. You know, and just look at how much this thing has been trending since like down here. Like this is only. I mean, this is less than a year ago when it was down to like 115, you know, $130 down here. And what we look for all the time is we look for a trend starting to play out. All right, let me see if I can just zoom in down here, go back a little bit in time and give you an idea. All right, so for us, all of this period here, all right, would be where we're not interested in doing anything at all in the market. All right, not a thing, because it's not really trending. All right, you can get a bit of a move and you can get a bit of a trade on here, but our focus is much more on investing in the longer term. So, you know, whilst I can sort of be paying attention to this kind of behavior change, which again is a big part of the process, I'm always looking for behavior change. If there's one thing that you can kind of zoom in on and hone in on, it's definitely like behavior change is massive for my part of the process. So that's always what I'm looking for. And then you start to sort of really notice, as with any kind of typical price action, you know, strategy or approach that you're going to go for, you start to notice that, you know, you're getting here a very different market, right? Where it's getting back above. These are all the moving averages, by the way. This is just like the 10-day, 20-day, 50-day, 100 and 200. All right, nothing particularly special. And then this here is the 52-week high, right? That's what that purple line is. Now, a lot of people, and this again, very much in FX, you sort of see something like that and you go, oh, it's overbought. You know, I'm gonna short here. I'm gonna play for mean reversion, basically. And you know, that's not what we do. We do the opposite. We want to buy 52-week highs, because a lot of the time, what you're seeing is a company, and as is the case with Micron, where they're starting to grow, the business is changing, and those changes aren't reflected in the share price yet. All right, so that really is what we're looking for all the time, and then you're just trying to ride that trend for as long as possible. And sometimes you get things like this where you can ride it for all of this time here. Like you can see, it's fairly obvious when it's green, you know, it's above all the moving averages. So we're in a trend and you don't have anything to do. All right. But then when you start to see again, the opposite behavior change, and this is something else that we're always looking for, where you start to lose the moving averages, you start to lose that kind of up only price action, then obviously we're aware of that for risk management on the other side, but we're not going like completely out of the market on that, because again, a trend can go on for a long time. So, you know, what we're looking for is it's kind of, and I think this is something that people kind of struggle with generally. You know, I certainly did for a while. It's holding those two sort of contradictory ideas in your head for a period of time where you don't know. I mean, we never know anyway, let's be honest. We never know what's going to happen next. But you're seeing this and you're going, oh, this is it. You know, a lot of people just go, that's it. It's over. I'm not going to, you know, I'm going to get out of this now. It's it. It's all over. And then obviously as you go forward, you see that we start to sort of get that trending behavior again. All right. And actually all we've done is just sort of found buyers around the 50-day moving average and started making new highs again. And we carry on with the trend again, nothing to do during this period. All right. Then you just get a day like this where you sort of got to be a bit aware, but you don't want to panic. I mean, we've been joking about that all year about the panic hands. I love Trump for introducing that term to the world. It's perfect because you see it on social media all the time. As soon as there's a down day, it's a bit like Bitcoin at the moment in reverse. As soon as there's like one or two up days, everyone's like, "That's it, the bottom's in. It's going to the moon." You're like, just calm down. And the same on the opposite side. You know, when it pulls back a bit, that's natural, that's healthy, it's normal. You're gonna get that. All right. And then obviously we got a bit of a deeper pullback. We got this sort of consolidation. Okay. And obviously just managing your risk during that time. Again, that behavior change is there. And then you start to notice we start making new 52-week highs up here. All right. Looks a lot stronger. We're not sort of doing this anymore where we're sort of, you know, making a high and then pulling back. We're now sort of finding buyers at higher prices, you know, and off we go to the races again. And it's really like this chart is sort of the perfect example of what we do over time. All right, and bear in mind, this is like we're looking at multi-months here, multiple months where this is going on. And every day, the process that I have is I'm coming in. All right, I've got my screeners set up for the stocks. I've got a universe of stocks that I look at. All right, which is mainly large cap US listed stocks. All right, so I want stocks that are at least 8 billion in terms of market cap. Generally, we do deviate a little bit from that sometimes. Some small caps do pop up if there's a theme. So you sort of got that broad universe. Try and get some perspective on where the attention is, because again, you get that because you can see the behavior change across different stocks, and you can kind of group them together. You know, just Not necessarily at the well, I mean, you can do it at the sector level, but I tend to look at the sort of more of the stocks in terms of the groups that are kind of correlated. You know, like you have like obviously memory stocks, for example, you've got like Micron, you've got SanDisk. If you go over to Korea, you've got Samsung and SK Hynix, right? And those are sort of all part of that memory trade. You know, you've got all of the semiconductors like your Intel, AMD, and so on. All of those are kind of grouped together. And you just sort of notice these things. And you're like, well, all of those are doing this. You know, they're either sort of selling off together, they're going up together, or all of a sudden the market's attention is on them. And that's where also the news comes into play, because you're looking at the news, seeing if there's headlines, if there's something that might be driving it. Again, often it is that there is some kind of fundamental change in the industry that the company is in. You know, it might be regulatory, it might be, you know, something really boring. I mean, even like Robinhood recently, you know, obviously we've had the day trading rule in the US has changed, you know, and that obviously is going to open up, you know, potentially a lot more business for them. They sold off absolutely loads, but you know, these past couple of days they've really picked up. And it's that is the process all the time, just going through the screens, looking at the market, seeing if, you know, if the leaders are still leading, because you do get leading stocks. And then you're just sort of trying to piece it together, you know, and think, okay, so where do I want to put my capital? Because we run it more as a portfolio sort of thing. I know what you're thinking of doing is probably more swing trading from what I understand. It's sort of a bit more active than probably we are, where we're just on the daily charts. But it's still very much, I think, the same principles will apply, but you just might want to be a bit more active in terms of your trimming and your adding and things like that at different points, maybe on slightly lower timeframes. But really, that's the goal. It's just paying attention to the market, seeing where the attention is, seeing where the money's flowing, and just trying to jump on board any of the strongest trends that have got the most. Again, we focus mainly on the fundamental sort of business as well. We want to try and have, because it's more investing, we want to try and sort of stack the odds in our favor in as many places as possible. So ideally, we're going to have stocks that are sort of seeing earnings growth and everything else, that are, you know, are good solid businesses. But you can jump aboard some hype trains and, you know, make some money just purely off of the momentum side of things there. But again, you've got to manage that slightly differently, because when they, a bit like the space, I don't know if you followed like some of the space names recently with all the sort of hype around SpaceX. There's been a load of names like that, and they went like up only, and then around just a little bit before the IPO date, they just went off a cliff, you know. And you've got to be aware of what you're trading, you know, because they've all got different personalities. And like if you look at something like Caterpillar, you know, big industrial stock that's actually done really well out of the sort of the AI infrastructure boom. We've been trading that, and again, it's just had fantastic earnings growth throughout, you know, all of this period. And there's been quite a few stocks like that. They kind of a bit. You look at them on the face of it, and you're like, well, they're boring. Like, what does Caterpillar do? You know, well, like they're just big yellow machines. Like, who cares about that? But actually, you know, they're doing generators. They've built out software for like, you know, automated driving of like all of their machines. You know, you can kind of think about that in terms of like even tractors and mining, and like it just kind of, and it goes well beyond that, and even like power generation as well to power the data centers and all those things. So there's just so much more going on in the stock market, which is sort of where I've found my home. If I'm honest, mate, that's really what it is. Just FX now. I couldn't care less about what some central banker said that made the price move 30 pips. I just couldn't give a fuck.
Yeah, when you were you kind of moving the chart very slowly, it was up, and I was like, ah. And then it was up again. I was like, ah. And then it was up again. I
Yep.
was like, whoa, this is
Yeah.
weird.
It's like,
What the fuck does,
yeah,
like, this doesn't happen.
no, it doesn't happen in FX, mate. And this is
Yeah.
like I say, this is daily time frame. You know, like you can have these kind of, like you say, on the 1 minute chart, you might get it for, you know, for a few days, but that's it then. And then it's like, no, this has to come back down, because again, it's a pairs trade, isn't it? You know, currency is a pairs trade, so there's always going to be a bit of, you know, push and pull where, you know, people are going to find value at different prices. It's a very liquid market, you know, so there's always going to be mean reversion in those kind of markets a lot of the time.
Yeah, and that it's very frustrating. And this has been actually like what you've just shown here with Micron is the perfect example of why I need to be looking into stocks. And when I was talking to XO, he kind of had opened my eyes to it. And Nicholas Kent from well, he used to work at Rain, but he doesn't work there anymore.
Mm-hmm.
And just a bunch of guys that have been like saying you need to get into stocks, you need to get into stocks. Showed me a few charts, and I mean, primarily I'm a breakout trader, and like this is absolutely perfect for my style. But not only, you know, you just nailed it on the head with FX. You'll get something where you might have a few days in the year. That's not a year, sorry. It feels like a few days in the year. You might have a few
Yeah.
days where it all goes up, and you're like, "Oh, great! This is perfect. Now we're going to finally have some action." Feels like the old days again, and then just like everything falls off a cliff, and you're like sitting on your hands for like the next 3 months doing nothing.
Yep.
I just want to pull back a little bit because you'd said when you look at stocks, you said you look at stocks with a minimum of sort of like 8 billion. Why
Yeah.
that number?
Well, it's just a little bit, but I mean, 10 billion is kind of like the generally accepted designation for a large cap stock. And the reason for that is that generally what you're finding there is you've got a relatively well established business. They've usually got some earnings, not always, but they've usually got some earnings. You've got a bit of history, a bit of a business that sort of you can understand. And also generally there's liquidity in there, and you can find that funds are going to participate as well, because a lot of institutions have market cap minimums that they have, that they won't invest below a certain market cap. So it's sort of all of those things. So obviously that's really what you want. You need the big money coming in. You need attention and big money to come into the stocks that you're in to drive the price higher. So that's really the main reason for it. It's sort of liquidity and the potential for larger flows to sort of enter the market alongside you.
Okay, got you. There's a couple of questions which we'll go into in like the next chapter when we talk a bit more about stocks. But you said obviously the way you're looking at it is more as an investing rather than day trading. And when I'd spoken to David and I'd initially said to him, "Hey, look, should I start day trading stocks? Because it just looks like the most obvious thing to do." And he said, "You don't even need to trade; just buy them and hold them."
Yeah.
So are you holding multiple different stocks at a time? You're always looking to add on to things? Are you mostly managing positions? What are your kind of like day to day looks like when you're at the
Right.
computer looking at this
Okay.
stuff?
Okay, so it depends. All right, let me just switch charts. Actually, that's probably a good way to visualize this. All right, so just bring up Nasdaq futures. All right, now at a time like this, all right, so bear in mind like what we saw here. This was all the sort of Strait of Hormuz kind of sell off. Oil was going up. Everyone was kind of like, oh, this is like this is terrible, end of the world. And stocks are pulling back and all of these things. And then right at the end of the month, you got this candle here. All right, big update, and you got a shift. All right, and then we just got into trend mode. So my goal really is to essentially fill up my portfolio as quickly as possible, right, with strong stocks that have all sort of sold off during this period. And I want to fill them up. Basically, I've essentially got most of the time. It doesn't, these things, they don't always work out exactly how you plan them, but the idea is that we've got 10 slots in my portfolio, and I want to have a 5% position in each if I'm starting from zero. All right. Obviously, a lot of the time I'm not starting from zero, so that's kind of all being juggled about a bit. But generally, the idea is that that's the sort of the principle. And then the other 50% is just in the index. All right, just in the S&P 500 in a tracker. So you've got the broad market exposure, but then you've also got the single stocks that are going to juice the performance. Is the general idea. All right, you're trying to harvest the beta, as the quants call it. The volatility basically. You're trying to extract the positive element of volatility when it's going up, so you can use that to sort of really grow, quite quickly when we're in trend mode. And then obviously you've got to accept the fact that you are going to have drawdowns in your equity curve from the highs, because volatility goes both ways. When you have a day like this, then you're in a different mode. You're in more of a risk management mode and are kind of thinking, right, I don't want to be as aggressive. So down here at this sort of point here, where you're seeing that you've got that kind of fundamental change, and this is where some of the macro stuff does come in a little bit useful. I never really thought it would, got to be honest, that we used to sort of cover a lot of the sort of macro side of things, and generally it just gets in the way. But after a while, you get to understand that the market only cares about the macro for a limited period of time, and really you want to be looking for opportunities among that sort of, in that environment. You want to be looking for opportunities, but then waiting for the conditions, that behavior change again that I keep talking about. You're looking for that behavior change to kick in, and then you're starting to get more aggressive. And then once you've got those positions on, then I'm really doing nothing. All right, that is the general idea: is to do less and just let the market do the work. All right, and I don't want to interfere with that process, right? Because I think we might talk a little bit about this at the end, sort of, but generally my view on sort of the whole thing about trader psychology and all of that stuff is that the human operating system isn't optimized for decision making. So the more decisions that we make, the more likely we are to fuck things up. right? That's pretty much the principle of it.
100%.
So once I'm involved, I'm gonna do as little as possible. If during this period I notice that I might be holding a stock that's underperforming versus sort of some of the others, I might say, well, you know what, actually, I'm just going to get rid of this one, or I'm going to trim it down, and I'm going to take that money that I've raised from that sale, and I'm going to put that into something else, either a new stock, or I'm going to sort of increase the position of one of the sort of stronger performers. Maybe do a little bit of rebalancing ahead of earnings, for example. If I've got a particular stock that's really outperformed, but then I've got earnings volatility coming in. I've got an earnings event where, it might go sort of 10, 20% down after the earnings. Generally it shouldn't do. But if I'm particularly overweight, then I've got to manage that risk a bit. I've got to trim that position down and sort of rebalance ahead of that volatility event. But yeah, that's the sort of generally do less is our kind of whole ethos. It's get involved in the market and then do less, do as little as possible. Because again, you look at like inverting. Like, I'm a big fan of inverting. The old Charlie Munger sort of principle. Like invert the problem, and then you get the solution. And a lot of the time, what people are doing is they're missing that this is happening, and they end up sort of micromanaging everything. They're like, oh, it's already gone up a lot, and you're like, well, define a lot. And is a lot too much? Does it? Is that actually a threshold for making a decision that's been reached, or is it just your emotions getting involved? So they sort of born out of that is basically just let the market do its thing and accept the fact that at some point, you're going to get something like this, and that's fine. That's the cost. That's your sort of your penalty, if you like. That's the tax that you pay for being able to ride all of this. And it's it's a relatively small tax when you look at sort of how this has moved. And like, this is the index. You look at some of the single stocks, and obviously they've done many multiples of what the Nasdaq's done. But obviously then, on this day when the Nasdaq has like, what was it, a 4.75% down day, those stocks will be down 10 or 15%, and your portfolio will obviously drop in line with that, but that's fine. You're still well up, and probably much better off than you would have been by trying to call a top because you just felt like you'd made too much or whatever other bullshit reason you've kind of given yourself. So yeah, and that's really the process. And then here it's just managing those risks. As we, you're sort of trying to trim those positions off, but you don't want to be too eager to sort of to exit the market entirely. But at the same time, you've got to be mindful of the fact that this is now a very different environment. Like here, you've got a very clear trend. Okay, and then obviously here we're now in a kind of very wide volatile range. It's just starting to contract a little bit, but volatility is still a bit too high to really sort of be comfortable with getting aggressive again. So you kind of, we want to see this now, this kind of play out, whether this might be it, that the 50-day might save the day, or whether we've got to dip down a bit further. Maybe we've got to wait a few months. That can happen as well, just for sort of conditions to set up again, and then there will be another trend. And that's, we just want to be ready for that. And when we are, that's when, it's kind of, it can be quite lumpy. The return sort of profile of it can be quite lumpy. But there's always opportunities around, even today outside of the tech sector, there's loads of stocks that are up.
Yeah, for sure. So if you're looking at this trend, you said you're looking for behavioral change, and then you're looking to get involved. So if you're looking at the chart, are you looking at that primarily from the candlesticks and then using the EMAs as kind of confluence for it? Like, what would be your kind of, right, things have changed here, we need to get involved, and then hopefully ride this? What would you see on this chart down there at the bottom which makes you say, right, I'm going to get involved in this?
Okay. Well, I think the obvious sort of thing here is that you've got a couple of things. All right. One is that it was quarter end. All right. So you'd already seen as well, sort of outside of this. So there's not just the chart. You've also got the sort of the fundamental backdrop that we had here with the straight and everything else. And at the same time as this is going on, if you look at oil around this date as well, it's sort of we were getting sort of worse and worse headlines around the straight and all these things, and the market just kind of gradually cared less and less. And then you head into quarter end. The funds at quarter end have to rebalance. So you often get a bit of activity heading into the end of the quarter as they're sort of doing that, because they've got to adjust their risk profiles, their volatility profiles, to make sure they're in line with their mandates of what they're promising to their customers that they're going to deliver. And then you also had obviously a load of leverage had been taken out during this time because there was all of this sort of deleveraging going on. And then you sort of notice, this day first, All right, and again, you familiar with Paracurve? If I'm talking about price action,
Yes,
Steve.
yeah, absolutely.
Okay, so you know all about the Quasimodo,
Yeah,
the over under.
yeah, I know about that. Yeah,
All right, so this for me, like this already was like a sign to pay attention, because it's like the end of the quarter, all right, and you've got this big up day. The market stopped paying attention to the oil risks, and sort of, and the attention is kind of, there is a limited, like there's an attention cycle. I think around the same time as this, Deutsche Bank had a really good chart, sort of just showing how markets don't care about geopolitics for too long, because they just sort of get to a point where they're like, we can't keep sort of discounting this. Like, capital has to be deployed. We've got to put capital in the market. It can't be sit here not earning anything, because then we don't earn any fees. Sort of essentially. And then you see that kind of that over under pattern down here, all right, alongside all of those things, and you start to see that kind of build out exactly as you would, when you're thinking about your kind of breakout strategy. And then you get this sort of this breakout move here, and then you get above the move, all of these moving averages on this day here. Like, you're building already at this point, but more cautiously. And then by the time you're getting this and then this, you're already sort of, not necessarily full sized, you're sort of scaling your way into the market. But then you're sort of, once you're above this and you're seeing these sort of, again, another update, you want to be in on your full position and paying attention to the feedback you're getting from your positions. That's a really big thing, because like when you're entering new positions and you're not getting positive feedback from the market, you've got to pay attention to that as well, and sort of think, right, I do need to dial back the aggression here. But when you're getting rewarded, it almost feels too easy, that's the time to push. That is always the time to push and be more aggressive, and really sort of just not, go all in is sort of maybe a bit over the top, but you get the idea.
yeah, that was going to be my question actually, because with my sort of trader hat on, I would say, and one of the things I was like been burning like to ask you actually when looking at this is, are you as it keeps going up, are you adding and adding, and then how are you managing your risk there with, like, again, this is my retail trader like hat on, is, are you adding stop losses in there? Are you like, how are you calculating things? How does it work for you?
Right. Okay. So there's a couple of things. So, like I say, you've got those position slots that we've got, right? We want to try and get up to 5% in each stock as quickly as possible that we want to be involved with. So I would break that down into tranches. All right. Basically, I look at trying to get 3 entries. I split 5% between 3. And, depending on the conditions, sometimes that'll be 2%, 2%, 1%. Sometimes it'll be a couple of 1.5s and a 2 and a 1, and a 2. And then sometimes it's just 2, 2 and a 1. All right. It just depends on the conditions and the feedback that I'm getting. All right. And then I set a mental stop loss that's based on ATR. But I don't ever put a stop loss in, because all of the decisions that we make are based on the closing prices, right? So we're looking at the daily close, because the intraday volatility is generally quite a lot higher than the closing price volatility in single stocks. You will get these sort of things. I mean, you must have seen quite a lot of these charts. If you've been looking at stocks a little bit, you'll see sometimes they'll sort of sell down. I mean, even the indices do it. They'll sell down during the day, and everyone will be like, oh, that's it. It's all so over. And then before you know it, you're closing green, you're closing at the highs, whatever it might be. And you don't want to get stopped out by that kind of normal volatility. I'm a big fan of looking at normal behavior versus abnormal behavior and understanding those things. I think that's really, really important to do. And obviously, yeah, because we're unleveraged as well, the leverage is kind of built into the market via the volatility. It makes it much easier to do that and still manage your risk, because you still own the stock. You haven't got any leverage. So you might lose some money sometimes on some of those, but you're not gonna kind of blow your account doing that. You haven't got the same risks that you have with a kind of retail leveraged account. Especially like you have to do it in FX, because you need the leverage to create the kind of the volatility, so to speak, that isn't inherent in the instrument itself. Whereas with stocks, it's already built in.
Yeah, 100%. There's like a really interesting switch, like mentally, I guess, which again we'll get into another in the next chapter. But if you're looking at these charts and you're executing, are you mostly staying on the daily time frame then, or are you using Confluence and other time frames to inform your decision making?
Right. I'm mainly making the decision based on the daily time frame, but sort of when I'm trying to get in and get involved in the market and get my positions on, I personally will be looking, slightly on lower time frames, down on sort of the hourly chart and things like that, because what I like to see in a strong market, again, this is very, very contrarian to the FX thing. is I actually want to see a gap, and then I want to see a little pullback that doesn't fill the gap, and then it goes up higher. All right. And that for me is a really strong sign that this market wants to go up, and I want to get straight in. I don't want to wait for the close, ideally, if I can do that in a strong market. All right. Sometimes when things are a little bit quieter and, you haven't got a trend, or sort of, like I say, when you're down here and you're not getting that sort of that same immediate reward that you start to get when the trend is underway, then obviously you've got to be a little bit more aware of the two-sided risks and a little bit less aggressive still. You're kind of going, right, I think it's going to go up, but I don't want to sort of just go piling in and whack on like the full position size all in one go, and then sort of panic myself out of it because it's like, oh, I was wrong, I've done something wrong here. I'm just going to close it to sort of relieve myself of the stress. And then obviously it does exactly what you thought it was going to do. So yeah, you don't want to do that. And that's a big, big change from the FX days where, you sort of have to be highly attuned to the market all the time because you're leveraged and because it does tend to sort of bounce and wiggle around in those same ranges, and then all of a sudden it will break out and you're like, oh fuck, I'm going to make a cup of coffee, and it's gone without you.
Oh man,
and that's
it's like
the move.
the worst thing, isn't it?
Yeah.
Oh, like literally the worst thing is stepping away for 5 minutes thinking that everything's all like calm and in control. I'll go into the house or something, come back and like, what the fuck has just happened?
Yeah, that's it. Like, that's the move you were waiting for.
Yeah.
But yeah, so it is very different, mate. It is very different. And like I say, you've just got to be sort of kind of trying to build into it and kind of being aware of those risks as you're building into them. But everything's much sort of slower and calmer generally. The decision process is, like I say, much more sort of, okay, what's the context sort of on that higher, that higher time frame on the daily chart. Some people even use, more, they use weekly. They'll just sort of come in and check in once a week. And sometimes, again, especially if it's trending, that's sort of the best thing you can be doing. Because again, it means you don't interrupt the process. You don't interrupt that compounding.
So when you're looking for opportunities, you talked about having like clusters of different sectors and stuff. Like, what are you like? How much of your day is spent watching the charts and looking for ways to get in or manage your risk versus looking for other opportunities and looking for other things to like get involved with?
Okay, so barely any time is spent looking at the charts, really. I would say I watch an hour, maybe. Probably maybe an hour and a half. I kind of, I sort of tend to watch the first hour of trade, and then the close. Really, that's the main times when I'm actively looking at the charts. And a lot of the time, that's more out of interest than any sort of needs to take action. It's just sort of maybe an old habit. I don't even know if it's necessary, but for me, I feel like I'm still kind of keeping a beat on the market by doing that. But again, like really, it doesn't change all that much. It's so. I could probably just say that the close is really the thing that I should be watching and the only thing I should pay attention to. But I still like to look at it a bit more. And then the rest of the time, it's that screening process. I'm reading the news. I'm trying to find what the next big things could be, the next shiny object that the market attention might shift focus to. And it's sort of, again, then you can kind of go off and you can, especially with AI now as well. AI is really useful as a research assistant for this kind of thing because if you use it well, you can sort of really have good debates with it and sort of try and kill the ideas. That's sort of how I use it. I use it the opposite way to, I think, how a lot of people use these things where they're trying to get confirmation bias. I try and do the opposite. I try and kill the idea. And if it can't be killed, then I think I've got something good. And again, that's one of the sort of same things that led to Ouster that David's been talking about a lot on the main account on Twitter. Which obviously they were coming out of nowhere with these new sensors for all of the sort of automated sort of anything really, like vehicles, anything that sort of operates in the physical world now. The more sensors are going to be required for those sort of machines, I guess, if you want to put it that way. I guess it's probably the best way for those machines to operate in various environments. They need to be getting as much good information into them as possible. And something like Ouster is, really sort of stood out because, they were enabling that. And they've had the market's attention, recently. Obviously today I don't think it's been a great day. I haven't checked. I'm pretty sure it hasn't because we're having a bit of a leverage unwind today. Let's have a look. Ouster's probably down. There we go. All right. But again, like it's, it was up what, 28% on Monday. All right, it was up another 15% on Tuesday. All right, we've given a load of that back, but the trend and the breakout is still intact. So there's nothing to, even though you're getting this volatility, like for us, there's nothing to do here. All right, and it might come back in. It might just be one of those where you just go, all right, it didn't work out. It might drop back in, and then it might get some attention again a couple of weeks' time. We sort of go through this period of, deleveraging and everything that often happens when you've had a strong trend. You often get a washout before you can kind of build a bit of a base and go higher again. But Ouster hasn't really had the same attention and time spent on it as something like Micron and SanDisk, for example, which have obviously been just building and building and building for multiple months. So there's a lot of leverage, especially out of Korea. A lot of leverage that's built up in Korea there as well, on the whole memory trade. So sometimes those, when you have the sort of deleveraging times, those can pull back more deeply than others. But again, we're trying not to get too emotional about it and trying to pick companies that we think the market will like. And then trying to back them and letting the chart sort of pull us in. That's one of my phrases, actually. I let the market, there's always saying that to people, like, let the market pull you in and then make it push you out. That's very much the principle of what we do. All right. So like I say, this here, a lot of people will be absolutely shitting their pants because it's gone down like this. And they'll be like, oh, that's it now. I've got to get out of this. I've given so much back. And you're like, again, you're missing the bigger picture, which people just tend to do. And you've got to just try and ignore that stuff. Ignore this sort of volatility like this. It's quite normal for a relatively speculative stock.
And you mentioned, you touched on it a little bit earlier about getting out. What would you, let's say, want to see in this? Let's say you've caught the bottom of this trend, for example, and it has pumped up. What exit signs would you be looking for you to go, right, okay, maybe this is done, or maybe I'm happy with the profits, or this is run?
Yeah, I mean, really, what you're looking for is, well, I mean, there could be a couple of things. All right, there's ways to measure like how overextended a stock is, and again, if you've built up a particularly overweight position, you can use those sort of what I use is the ATR extensions. So basically, you take the ATR and you add multiples of that above the 50-day moving average. All right, and you'll see quite a lot of the time that once a stock reaches like sort of roughly 10 times ATR above the 50-day moving average, it's more likely to have a sort of pullback or a consolidation and less likely to just keep trending. But even that might only be a 2 or 3 day thing. So you sort of, again, you've got to use that sparingly. I tend not to use it other than for sort of using it as a rule to not enter, if you see what I mean. Because obviously I don't want to buy, people talk about, I don't want to buy extended charts. And it's like, okay, well, we need to define what extended actually is in some meaningful way. And that's what, I've created an indicator for it for the guys at Fink here. And you're just looking at something like this. All right. So if you're up in this kind of area, sort of 7 to 10 times ATR above the 50-day, this for me would be I don't want to buy as soon as we're up here and like everyone's going, oh my God, it just keeps going higher. I've got to get in. It's like, no, that's a really bad thing to do. But what will happen then is that you get this kind of correction that can be a correction in price, or it can be a correction in time where, the market just finds balance at this higher area and you get a bit of a range, a bit of a sort of flag type pattern, something like that. And obviously what's happening at the same time is the 50 days catching up. So the sort of the trend is kind of being reinforced because obviously it's lagging because it's based on obviously 50 days price behind. But obviously the multiples that you're above that, all the time that the price is here, the 50 days catching up, even though price is going sideways. And then all of a sudden it's like, well, actually, this isn't as extended as it was. And now it's looking positive again. And you can add to it, you can get involved if you're not involved already, and so on.
Okay. Yeah, that's quite a cool little tool, actually.
Yeah,
because I mean, I guess half the problem is when you've seen these things that just absolutely run and then they take a pullback, and typically I would start going, right, I need to, with my FX head, I need to get out of this because we're going to go right back down to the origin of it and return to sender. You might then miss up another, like, it might go up another 100x or something by the looks of some of these fucking things.
exactly. Mate, I mean, SanDisk has been the perfect example. SanDisk has done something like 45x over the last year. It's insane. And again, the amount of times that people kept trying to call the top on it, and then it just kept blowing past all of those things. It was just, it's just funny. Like, obviously, they're not all going to do 45x. I wish they would. That'd be so easy. But you know, it's just sometimes that you are going to get stocks like. I mean, Nvidia was another one. I mean, how many people with Nvidia going on the way up? You know, all the way up, it was like, oh, it's too high, it's going to come back down. Oh, it's too high, it's going to come back down. And then before you know it, it's like the top company in the world.
Yeah, yeah. I mean, every time I look at these things, I'm just I need to get involved in this. Kind of last question on this section before we move on is the amount of discretion you have in it versus being able to automate it. Have you looked into automating things, or because the amount of time you said on the charts isn't that much, and you're using AI to screen for opportunities? Is it something you're looking to implement more in your process, or is it, you're quite happy with what you've got now?
No, I mean, I'm very happy with what we've got now. I mean, I think you probably could systemize something like this, to be honest. But you do get times like, it's if you build mechanical rules, like I mean, like Ouster here would be a good example here, where you sort of, you're getting like if you were to say, right, I'm gonna trim some of my position here every time it closes below the 20-day, and I'm gonna add every time it goes back above the 20-day, for example. Then you're gonna sort of be churning quite a bit and sort of taking positions, and it's gonna, you're gonna be paying, you're going to be paying well. You might be paying in some cases, like you're going to be paying up and sort of paying the gap here, for example, and you're obviously going to be paying transaction costs as well. So it would become more active if you did it that way. And I kind of, again, you're using the trend sort of as more of a kind of as a guideline rather than a sort of something that you just absolutely have to execute around. Because a lot of the time, again, the reason why we use closing prices is that you'll get something like this and it will close below the 20-day on one day. But then the next day it will gap up immediately and open back above the 20-day. And it's like, okay, so while the market's open, I've actually got nothing to do. I've got the sort of the signal, so to speak, of it closing below, a moving average that might give me the signal that I want to manage the risk. So I've got to be paying attention. But then the next day it gaps up and just keeps going higher. So there actually wasn't anything to do. And it's quite hard to actually try and automate something like that to have that little bit of discretion there. So I don't, and again, like because we're not managing loads and loads of stocks and we're not trying to be really, really active in the market, I don't think that I actually think it would be detrimental for us in what we do if we did automate it, because again, it would make us more active and it kind of goes against the ethos of doing less and trying to just stay involved in the trend for as long as possible and really making sure that the market's going, no, you need to fuck off now. This is done before we get out.
Yeah, fair. Yeah. I mean, I'm venturing into automated trading somewhat at the moment, but yeah, there's certain parts of it where it's like I can imagine if you've coded something to take the trades for you, it will take it like blindly, whereas you might just go, oh, there's just something in the air doesn't feel right here, and I don't want to get involved, right?
Yeah.
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 All right. I'm going to move on to the second section and call this trader lifestyle and background. And just kind of want to know a little bit more about you, mate. How you got involved with trading as well. What got you interested in it? Obviously, you started out well, I don't know. I think you started out on FX, and then obviously you've made the move into stocks. Like, what was the beginning of your journey? What did it look like? How you got involved, and what kept you interested, really?
Okay. Right. Yes. So it was. I got started back in 2016, and I think I probably got started how a lot of people get started, which is I had a mate, and my mate said to me, "I'm going to do this little thing on the side. It looks like easy money. I'm going to sort of trade FX and everything else." I was like, "Yeah, I could do a bit of that. Let's do it together." And just started off. I think it was. I'm sure I started off with forex.com with like their platform at the time, and I remember it had like the automated sort of stop loss and take profit was on there, like it was automatically configured for a 30 pip stop loss and a 30 pip take profit and all this stuff. And I was just like, yeah, I'll just do that. And I had no idea what I was doing at all. But for some reason, I just kind of kept at it. And then I think during that time as well, I kind of went personally, I kind of started to undergo a bit of a personal revolution, because a lot of the things that I thought about the world were sort of suddenly thrown into disarray with like Brexit and Trump and all of those things. And like, I didn't know anything about politics. I didn't really care about politics, all of that stuff. But then those things happened and it kind of shocked me into like, you don't understand enough about the world. Like there's stuff going on that you don't understand. And yeah, that really got me more interested in everything, I think, and I kind of saw the market as a bit of a lens that I started to see things through, and I think that was really just coincidence. It wasn't, deliberate in any way. But I remember, trading the run up to the election, and I cringe when I look back on this. But Hillary Clinton, there was like something happened with her emails or something like that, and I was like, right, this is going to be like bearish the dollar, because at the time the idea was obviously if Trump was going to win, it was always bearish the dollar. That was how things were going, and I was like, it's going to be bearish the dollar, but it happened over the weekend. So me being naive and everything else, I put in an order to sell. I think it was to buy Euro USD. And obviously, what happened was exactly what I thought would happen. But because I put the order in over the weekend, it executed at the best price after the market opened. And I'd had no idea how I hadn't made money on this thing. I'd been stopped out, and I was like, "How has this happened? Like, I don't get it." And I called the guy that started off with the broker, started the account at the broker, and I was like, "What is this? What's happened here?" And he's like, "You're gonna have to speak to customer support, mate." And I don't know. And it was just, he must have thought I was such a mug. I really cringe looking back on that. But then I kind of kept sort of, trading it, and I kept seeing these things. And then actually, when Trump was elected, I think I lost about, I think about 600 euros, something like that, like in about an hour. And maybe this was the first clue that maybe I was sort of prepared for this kind of game, I guess. It was because like a lot of people were like, "Oh, I've lost so much money, and it's the end of the world," everything else. I was like, but I could have made that. If I'd have done the other things, and if I knew more, I could have made that money in an hour. Like, and from there, I then just started exploring things. I started, doing strategies. I did Trader Dante's course as well, and that really set me up in a lot of ways for understanding the market and understanding the business of markets. Although I really can't trade the way that he does. It just doesn't align with my perspective at all. I can't deal with the level of precision that he requires, and I tend to be a bit more intuitive in the market and sort of try and look for the trends and the moves and things like that. So I never really got the hang of his trading style, but his sort of views on how markets work and all those things really built in a lot of my sort of underlying principles, I guess, of how I approach markets over time. And then, I just kept doing that. And then I met David in 2018. We both sort of started doing a bit more of the macro side of things. We were learning about, macroeconomic. Well, I say learning. I was learning. He was teaching, to be honest. I was learning all about the macroeconomics and how it affected FX. And there was a really lovely Aussie yen trade as well, when we had all the recession fears and everything like that. And that actually was a beautiful trend. It was a downtrend for multiple months, which was just fantastic. And then from that, sort of when COVID came in, and we were sort of doing a bit of crypto, and we started to pay a bit more attention to stocks, and I was just sort of everywhere. I was kind of a bit of a journeyman in a lot of ways, and I never really settled on a particular trading style or what's the right sort of a kind of a fixed approach, I guess, is probably what I'm talking about. Like you've clearly got that. You've got sort of quite defined rules of how you approach the market and what you do and what you look for and all those things. And I was much more kind of shooting from the hip, which again has its positives and negatives, because sometimes you might be sat there kind of going, "Oh, I'm waiting for my perfect criteria because I know that's what I've studied and that's what works," and I'm just like, "Yeah, fuck it, jump in." And then other times I'm like, I've done that, and you're sat there going, "You should have waited for the setup," and I'm there going, "Yeah, shit." So it was sort of, again, it sort of created a bit of that volatility in my own equity curve and my own sort of psychology as well while I was approaching things. And I think that's where I never settled down. And then obviously moving into stocks, I kind of found, like I say, I found my home, because I'm quite happy with the volatility. I prefer the volatility. I really do. And I like being able to sort of as well kind of understand the story of companies and how they're growing and how things are sort of, again, it's still that same thing, understanding more about the world. It still is part and parcel of what I'm doing, is just kind of putting those pieces together of how the world works. But obviously now I do have a much more systematic approach to what I'm doing when it comes to obviously investing, basically.
Yeah, I think same as you. Like I flip flopped for many a year. I kind of had a general sense of direction because I had a mate that, mate got me into it, and he kind of said, "Right, I've tried out all of this shit. Don't worry about it. Just stick with price action. Just stick with like supply and demand trading, and this is how you go with it." And thankfully, I just ran with I just trusted him and just ran with it. But like you, yeah, you go through all the pitfalls, don't you? Of like, it's going up, I'm just
Yeah,
going to buy it. Oh, it's going down, I'm just going to sell it, and
yeah.
yeah, all that kind of
It's
stuff.
constantly chasing.
Yeah, yeah. I think it's a rite of passage. I think really I kind of say one of the things you see online is, especially with like nowadays with all like the bullshit you got on there. I've been trading for 3 years and I'm profitable and blah blah blah. And I'm just like, you haven't seen enough cycles yet. You haven't seen enough. You haven't, not only of the markets but of yourself. And I
Yeah,
think really it is sort of like between 8 to 10 years is when you start to really understand yourself, understand the markets, and understand really about building some sort of process.
yeah.
So in that time, have you? Yeah, I know you said about Tom and David. Were you looking for like other educational things at that time and trying things out, or were you kind of just trying
Um,
to figure it out on your own?
I think a bit of both. A bit of both. I think I've always been that way. It's like I'm never looking for the secret. I don't think that's one thing that I never fell into entirely. I think there's always an element of kind of, I just need to know more and then I'll have the answer. But I never really thought I'm just going to find like the holy grail or anything like that. Just this one other educator, this one other course, this one other thing. But anyone who's sort of who I don't know, I kind of assessed and thought, I think actually they know what they're talking about. They're not just a bullshit merchant. Then I did do a couple of sort of courses and things like that. Like Paracurve, I did buy his course as well. But other than that, generally, yeah, I've just sort of chucked myself into it and tried to test things that I've learned from other people and kind of gone, right, that's dumb. I'm not going to do that. That actually makes a lot of sense. I'm going to do that. What if I adjust it to do this? And I'm sort of, a bit like a mad scientist, kind of just in my lab, chucking ideas out. Like, that's no good. That'll do. Put that in, and just sort of constantly doing that process of kind of mixing things together and figuring it out. And by doing that, I'd sort of come to the same conclusion that I think most people come to, which is, everything's either trend, mean reversion, and you've got to have some kind of appreciation of volatility. Outside of those things, there's really not much else that is going on. You've either got a trend or you haven't, or you've got a mean reverting market or you haven't. And it's just, and that's sort of what, and the volatility as well. At certain times there's more volatility, so you can kind of try and get involved, but you've got to obviously adjust your position size to allow for the volatility, because you don't want to be sort of thinking like, mate, I remember the dark days of FX when like euro dollar was moving like 20 pips a day regularly. Even the SPX as well was barely moving, and you're just like, Jesus Christ, how am I going to make money in this? There was no volatility anywhere. So like COVID was an absolute blessing for that. Actually, it really did sort of bring back some volatility, at least to everything. And yeah, I think those things, if you appreciate that everything is like a derivative of, trend, mean reversion, or, and you've got to understand volatility so that you're understanding the correct position sizing on what is normal market movements in over a given time period. Then, generally it's just, you're set. You just have to pick something within that makes sense to you and do it consistently and then adjust as you go. Which I think is very, very different to how most people approach markets. And certainly different to how I first approached them as well.
Yeah. When I was listening to you, then I was just in my head thinking confirmation of what I think is essentially, we as traders, I think we're naturally like a little bit higher IQ, even though, I mean, you speak to some people and you'd question that, but generally speaking, the things that draws us to markets is we have a bit of a higher IQ, and that means we kind of want to overcomplicate a trading system. We think it must be this really complex thing, but as you said, it's either going to trend, or it's either going to like be a mean reversion market. It's either going up or down, like, like, it's
Yeah.
like that's all you're going to have to like focus on, really, isn't it? Is there anything that kind of sticks out in your head from how you've like what you've gone through, which kind of was like an aha moment and like, all right, this is going to change how I now go forward? Or maybe the opposite, where you've had something where you fucked up so much and you were like, right, fuck, I'm no more, I'm going to change for now. Have you got anything like that stands out to you?
I think the macro is probably the one thing, like actually just realizing that sort of understanding the macro doesn't give you any kind of edge. And if anything, again, it's that it adds complexity and complication of something that most of the time the market doesn't care about, like the economy, and sort of being really, really hyper focused on, whether the NFP was a beat by how much, or, or a miss, or whatever it was. A lot of the time, it just, in the big picture, it just doesn't matter. It really doesn't matter. Like, markets care about the macro at very specific times. And even then, they only care about them for a minimal period, like the minimum necessary period, if you like, just to say, oh yeah, we cared, we did our job, but now, we're going to forget about that and move on to the next thing. And, a lot of the time that might be, maybe 15, 20 days, sometimes less, sometimes more even. But most of the time it's like, it's a very limited period. And again, you don't really need to be focused on it. You just need to notice that there was a change. Like, I think it was like in 2022, we did the whole recession trade. I remember Bloomberg had like, 100% probability of recession in 2022. And you're like looking at it going, really? But we were getting rate hikes, and obviously, again, the market has to care about rate hikes because it has to reprice everything if we're going to have higher interest rates, and then obviously vice versa when we sort of get rate cuts. And obviously with something like the Strait of Hormuz, where we're getting higher inflation, because that can lead to, it can lead to higher rates. So there's a necessity that the market has to pay attention again to that and reprice. But really, like how I was approaching it before, where it was like, it gives you I think it gives you a sense that something has to happen. It gives you a kind of false certainty. And that, I think, is probably the biggest aha moment. Is just like, I'm just not going to give a fuck about the macro anymore. I'm not gonna put it in my process because it's getting in the way. Like, and really, the job is a job of making decisions. That is literally our job. It's just we have to make decisions. And the more things that you have in the process for making the decisions, again, the more muddied and muddled your decisions are going to be, because you're trying to think about too many things. And during that period as well, I'd sort of look down my nose a little bit at kind of people that only traded price action. Like, how can you only trade the charts when there's so much going on? But it's like the charts are telling a story as well. So actually, the opposite can also be true. And often, I think, is more true, because the market is what you're trading. You're not trading the macroeconomy. You're trading the market and the market's perceptions of whatever is happening in the world, that sort of necessitates some kind of repricing. And that will happen on the charts. It will happen in price. It doesn't happen in some fucking economic model that some, super intellectual has come up with. And oftentimes as well, they're really wrong. But I do have an appreciation now that I didn't have before of sort of economists and how difficult that job is. I have got that. It's been a kind of recurring theme, actually. It's sort of, once I've looked at people and gone, oh, it's sort of, if you don't do the thing, you don't understand it. And every time that I've done the thing, I get a new appreciation for people that are doing the thing. Even if I think what they're doing is dumb and I wouldn't do it again, I do kind of appreciate the effort.
Yeah, it's funny you said that about the price action, because I was thinking that, and then the reason why I just focus on the price action. I've never really been involved or interested in politics, like how you were saying. I've never really used news to make my decisions. And anytime I talk to people about it, they're just like, how can you be like that? How can you trade? And one of the funny things that I've always seen is people that they do focus on the macro, and then they're trading like the hourly chart. And it's like, that doesn't really work together,
No.
So it was funny you said that, actually.
Yeah, I do think of it like, that bell curve meme. I do think a lot of
Yeah.
that whole journey is like the bell curve meme, where you have like that kind of idiot at the start, the low IQ idiot, and then you get up to like the mid curve, where you've got this kind of, no, you can't do this, you can't do that, and then you've got the kind of the other side of it, where the guy's like has the same opinion as the simple kind of idiot, but it's an informed opinion, and he's ignoring everything in the mid curve. And I think it is just absolutely 100% true in my experience.
Yeah, I fully agree with that. Like, the guy on the right is just able to like explain it better. Like, the guy on the left,
Yeah,
oh, it's going up, I should buy. And then the right's like, well, yeah, the data says it's going up, so I might as well buy it. Yeah, that's
exactly.
and that's kind of given me a broader view on society as well. I think you can apply that
Yeah,
thing like basically throughout. I mean, I don't want to get into it, but if you look at things like immigration at the moment, you'll have people who have informed decisions on one side who get absolutely annihilated by the press and by the sort of the middle curvers, if you want to call them that, because they will say, you're like those chavs over there, you're like those low IQ people who say that, and how could blah blah blah. And I kind of feel like that meme is, when you look at the stats of who's successful, the numbers of people that are successful with trading, you've got that kind of mid curve, mid-wit sort of people. I feel like, yeah, to go back to the other point, people overcomplicate things, and they have to. I've actually got a little skit I want to film at some point based on this, but they're kind of like, you've got to take 50 different things into consideration, and you get this decision fatigue where it all comes down to it's breaking out of a range, it's going up, let's buy it. Like, that's all it comes down to, right? So you said as well, when you first got into trading, or especially around like the Trump and Hillary time, that it changed your worldview. Is it, how has it changed you as a person, like on a day-to-day level, do you think, as well?
Massively. Like, I'm so much more open-minded now to everything, and also as well, it's sort of, I can actually put together a couple of things that you just said and give you an example of this now thinking about it. Me and David had a chat I can't remember, about 6 months ago, when everyone was being very very uptight and very angry about immigration, and it was kind of all in the headlines, kind of more so than ever. I know it's always in the headlines in the UK, but more so than ever. And we came up with the idea that you can either get angry or you can make money. We actually created a UK immigration basket of stocks.
That was genius.
So the stocks that benefited from immigration. So it's like, and obviously because the government's just paying for the hotels for the immigrants, and it's like, when you've got something like that, it's a dream for a business, because they can charge whatever they're going to charge. They're going to get max capacity in the hotels because there's an unlimited supply of people coming into them. You couldn't ask for a better payer in terms of the government, because they're always going to pay. It was the perfect mix. And I think it went up something like 60, 70% in a few months. It was just like perfect. And that is now very much more about how I look at the world. Like, can I do anything about it? No. Okay, then there's not much that I'm not gonna get that upset about it. I'm not gonna let that impact me. I'm not gonna pay that much attention to it, because I've only got a limited amount of attention. And again, just try and live a simpler life in a lot of ways, and a less emotional life about things that actually don't affect me directly and aren't impacting me. And yeah, that sort of, it narrows, in some ways it gives you a wider perspective on what's happening in the world, but it also narrows your focus on what you need to be doing yourself, I think. And that's probably been the biggest personal change that I would say that I've gone through over this sort of 10-year period that I've been involved in markets. Because I was very much like, that kind of typical, extremely online person. I had very strong opinions about things that I didn't know anything about, really. And that all became very apparent during the time that, around Brexit and Trump and all those things. And I was like, oh shit, I don't understand much of all of this. And David actually helped a lot with that. David's been really instrumental in my sort of development as a sort of a trader, investor, and as a person, to be honest. Even though he's younger than me, funny enough, he's just, he's a unique guy. He's got a lot of experience and maturity for someone who's, well, he's in his 30s now, but he was in his 20s at the time when I first met him. And he's always been able to put together sort of well-rounded arguments and make the case for both sides, and try and, again, a little bit like I said with the AI, you sort of kill his own ideas, and the things that can't be killed, you kind of are the things that survive. Because that and you do see things like that everywhere.
Yeah, he's smart beyond his years, and Tyler has invested in Fink, and we've had conversations, and we're just like, he's a very smart dude, sometimes a little bit kind of all over the place, and and he supports Man United, but yeah, very very smart dude overall.
Yes.
Which is like, that immigration basket, when he did that, I was like, that's fucking brilliant. That was so funny, but also brilliant at the same time. Yeah, the other question I just kind of wanted to ask, what your sort of day-to-day life looks like nowadays, and with regards to your trading, what sort of habits you kind of make sure that you have each day or each week to keep your mindset clear and to just stay on top of your game. Have you got any kind of essentials that you live by?
I'll be honest, mate. It's nowadays it's exercise. It is going to the gym, and I've also taken up in the last. I was thinking it's about 9 or 10 months. I've been doing it now. I've been doing boxing and Muay Thai, like two separate sort of things. Just go and do the classes, and different groups, different skills. We started doing a little bit of MMA recently as well, which has been good, a bit like jiu-jitsu type stuff, which I'm enjoying that as well. And yeah, doing those things for me is just. It's probably it's like mental health wise, if you want to get into that sort of thing. I know it's all fucking cliched now, isn't it? Mental health, but I feel much better for doing it, you know, and I really enjoy it. I really enjoy it. And it's a way to sort of challenge myself. And I need other things so that I'm not sat fiddling with the markets as well. You know, it's so, because like I said, I don't spend much time, you know, like on the charts and sort of executing and doing those things. I just sort of spend time researching. I spend time, you know, like I can just go and, you know, I work from home as well, so I can, you know, when the kids are back from school, I can go and see them. You know, and then yeah, just exercising and, you know, spending time with people. It's really quite laid back, and for me at least, like I know everyone has their own sort of processes and everything else, but I'm not the kind of person that is really good with excessive structure. You know, I know that a lot of people are like, no, I've got to have, you know, I do this at 7:30, I do that at 7:45, and then I'll go and have a shit at 8. You know, whatever it's like, and it's like regimented like that. I can't live like that. I can't do that. And I actually think for a lot of people that are doing it for maybe the wrong reasons, if you like, as well, that they're just doing it because they saw that someone else did it and they thought, oh, I'm going to do that. They're actually sort of, I think, making themselves fragile, because if you sort of put, again, it's sort of complexity, you're putting too many parts in that, and you're like, oh, I didn't have my coffee at 7:30, I had it at 7:50. I'm all out of sync now. And like, you make yourself sort of fragile because like that, because it's not, everything's not perfect. It's like, oh, I'm now out of whack, I'm out of sync. So now, because it's not perfect, I'm now not necessarily quite where I should be mentally. And especially if you're going to like trade, you know, on lower time frames and things, you've got to be sort of in the right space. But I generally just think that it's, for me at least, it is kind of just sticking to the basics and trying to keep it as simple as possible is the way that most people should approach things. Generally, you know, if you find that there's certain things that you're like, certain bad habits that are creeping in that you need to deal with in one way or another by putting a bit of structure in, then by all means do that. You know, but don't go over the top with the structure. Is my general view, because I think it actually constrains you too much, and it can lead to almost like bad behavior, a bit like sort of, you know, when you're sort of really strict with a child, and then like not necessarily a young child. I know you've got you know, yours is very young, but like, you know, as they're getting older, and if you try and be really strict with a child, what they're going to do, they're going to rebel. So you're going to rebel against yourself, which means that as soon as you're in that kind of rebellious mode, then it's, you know, like a child, you're going to chuck everything out. You're just going to, oh, fuck all of this. I'm just going to go full size long, whatever it is. And then like, that's it. You know, your account's done, you know, massive damage, and you've got to then try and recover from it while you're beating yourself up for being such an idiot.
That's a really interesting point, because one of the things I used to be a swing trader for my first sort of 7 years in trading, and then went full time 2020, end of 2020, and found myself, the problem I had with swing trading was that I had way too much time, and I was trading on a higher time frame, and I just had to do stuff, right? So I moved down to the lower time frames, also in the hunt for volatility. But I realized that it took way more emotional control, and I had to structure my days way more, and I had to fill it with things that like improve my mindset and maintain my mindset. And you're right, I became extremely regimented, where it's like I have to do this, like I have to go for a walk, I have to go and do some meditation, I have to go and read a book, I have to like do a bit of back testing. And I got so used to that when I had the kid, it completely threw me off, and all of my systems, all of my processes got affected. And I'm now kind of just getting to the point where it's like, it doesn't matter so much if I think a gym is non-negotiable for me, but it doesn't matter so much if I don't do the back testing, or it doesn't matter so much. Like my missus, it used to drive her wild. It would be like 10 p.m. and I'd be like, hold on, I've got to go do my journal first before we just go and watch the TV. And she'd be like, can you just fucking leave me? I'm like, no, I've got like a 3-month streak going on, doing it every day. And I agree. Like I'm now kind of shifting to that mindset, which you just said, where it is actually kind of detrimental, really, because you kind of go, oh,
It's not sustainable.
No, it's not sustainable. Yeah, especially with kids, right?
Especially.
Right, I'm going to move this on to the next chapter, the meat of this. So getting started with stocks. And I'll give a little bit of context as well to my own journey, because when I first started trading, I say I started in 2015, but my first foray into trading was in 2013, sort of like the end of 2013. And it was in stocks. The same guy that got me into FX, he started in stocks, and he's like, you got to try this. And one of the problems was I was like too young and dumb. But the other problem I found was like having there wasn't a huge amount of like content out there about how to get involved and like how to stay on top of opportunities, how to screen for them, which I want to get into with you with Fink. And I remember one of two things stood out to me, and the second one was the one where I was like, "Fuck this, I'm not doing this anymore." The first one I got involved in was EasyJet at the end of 2013 because I was looking to go traveling. I was like, "Fuck it, they're everywhere, so I should try trade them." Lost a bunch of money there, and then the real one that kind of I said this is way too complicated. There's way too many moving parts, and like I said, I was a bit dumb, and there wasn't a huge amount of information on the internet now, and everything's on the internet now. I had found, well, me and my mate had found this pharmaceutical company. I can't remember the name of it, and I've still got the trade slip, and I don't know if it's the same now, but back then when you've got your quarterly earnings, that everyone releases their quarterly earnings at the same point, but this particular company, for example, they released theirs while the market was open, and for the previous 3 quarters or something, every time that they'd released their earnings and they'd done their quarterly report, their stock had pumped like 200-300 points. And I remember this was like the year end of it. It was February or March 2014, and we were like, right, let's put some money into this, because if this goes like it's done in the previous like 3 quarters, fuck me, we're gonna make loads of money. And I remember putting 2 grand in it, and this is when I was living in Valencia, and I was like, I had a chunk of money behind myself, and I was writing articles online and getting paid for that, and I had this buffer of money. I was like, I'm going to put 2 grand into this, and if it goes and does 200 points, then I was like, oh well, like how much money am I making here? And they came out with the year end report, and they started it off with the president of the company's like leaving, and it tanked like I think it tanked like 50 to 80 points, completely wiped my position out. And then they went onto it, and then it rallied like 300-400 points, and I'd been taken out, and I was like, I'm not doing this ever again. Fuck this. So that was like the last time I ever looked in stocks. And other than like, I've had a Hargreaves Lansdowne account, and I've like played around with some things, but most of my sort of investing life and trading has been in FX and crypto. So kind of a newbie kind of question really is, as someone who I still like to be actively involved in trading, but the way that you're describing getting involved in stocks, particularly on a higher time frame, and then just being kind of a little bit hands off, sorry, is very appealing to me to have on the side, and to start with on the side, it may end up taking over. Because as you said, we're having kids and a family. I've found that I can't be as regimented with my day trading. Way too many things like get thrown in the works that just completely throw me off. If I was to, and feel free to plug what you're doing if this is what your genuine answer is, but if I was to say, right, I've got 10 grand aside, I want to go and start getting into the stock market, and I want to grow this capital, and I've got all this trading experience, I know how to read charts. I feel like in terms of geopolitics and worldview, I've kind of got that I don't know what you'd call it, but I see through things. Like when you talked about Brexit and Trump, I was actually the complete opposite. I was going on forums at the time and talking to people and seeing who was like really bullish on Hillary. And I have an American friend, or well, I've got a few, but at the time I didn't have many. And she had said Hillary's 100% winning. I was going on all these forums, like with kind of like red pill forums, who were all like, no, this is the mainstream narrative is completely wrong. And I wish I'd made a bet if I'd known how to, but I remember sitting up watching the results of Trump get elected, and this forum going ballistic about, we've done it. This is exactly what we said. So I feel like I've got the right worldview. I feel like I've got the right trading experience. I feel like I've got the right sort of strategy and approach for trading. How do I get involved? Like what steps would you say I should take to be like, right, go from complete beginner to start looking at things and start making money, really?
Okay. Right. So, I mean, the first thing that I would say, if you haven't done it already, is open an ISA. I know you might be moving away at some point, but take advantage of that, because it really is a big benefit the UK people have got that a lot of other places don't. Like where I am in Spain, we don't have anything like that. So you're always kind of fighting the tax system to kind of compound, because obviously taxes get in the way of the compounding process. So you've got to kind of find ways around it, and using different funds and stuff like that. Or I have to, at least, which you wouldn't have to do because you're UK based. The ISA is a fantastic thing. I would also probably, I don't want to sort of throw shade on them too much, but I'd move away from Hargreaves Lansdown and go to IBKR or IG. Even trading 212, not too bad, to be honest. But certainly Hargreaves Lansdown are quite brutal on fees. They're not the cheapest. So yeah, I mean, IBKR is probably the best of the bunch because you've got just the most choice globally of whatever you want to do, and then it's all pretty low cost as well. And then I guess it's a case of setting things up so that you need to have your approach kind of set up in terms of the time frame that you're operating over and what you're trying to do, as always, as with everything. So are you going to be more of a swing trader where you're trying to sort of generate profits and you're not bothered about sort of trying to ride out the entirety of the trend? You're just like, okay, if I get a 30 or 40% move, that's more than enough for me. I'm going to exit that trade. I'll move on to the next thing. Or are you going to be the kind of person that really wants to stay in the market for as long as possible and sort of, again, make it force you out? So some of those kind of decisions are, they seem quite insignificant, but I think they're really, really important to make at the beginning in terms of what you are actually intending to do and how you're going to spend your time. And again, you might change that, but sort of settle on something to start with and say, this is what I'm going to do. And then obviously if you find that that's not quite working, or actually, you find that, if you look at your trades afterwards, like a couple of months down the line, you're like, Jesus Christ, like everything I've sold is already up another, 40, 50%, whatever it might be. I'd be much better off not doing it this way and just actually putting in less effort and less time, which is like, that, if anything is the holy grail, is to make more money by, with less effort and less time spent at the computer. And just sort of, keep assessing that along the way. And then you've got to leave behind anything. I mean, generally pharma and biotech, I would steer you away from most of the time as sort of somewhere where you want to be active, because it is a very specialist space, whereby you're getting things like I was a bit surprised actually. We said that they released the earnings report while the market was open, because most of the time it's before the market opened or after market closed now. I don't know if it was different back then. But yeah, it might have been a kind of maybe it wasn't actually the earnings report. It was like a preliminary sort of report where they were like kind of saying, oh, by the way, the president's leaving. But actually everything's going great and we'll tell you more about it on our earnings later. Maybe it was something like that rather than the actual official earnings report.
I'm going to try find it while you speak, because I've still got the slip. But
okay. That'd be interesting. But yeah, generally those names can be extremely volatile, and they're very, very sort of subject to that specialist knowledge of kind of pharma and drug development and trials as well. Like you'll see some of these biotech stocks will just go up like 200-300% on the idea that they've got this new revolutionary drug, and then they'll tank like 80% in a day when the trial fails. And that'll be that, that's all she wrote. Thank you very much. And it's like, okay, so I've sat in this for 6 months and I've got nothing for it. Maybe I might have taken a loss even after 6 months, and no, thank you, because you don't get a chance to react to something like that. The market moves pretty much instantly. So yeah, I mean, sticking to the idea of filtering the stocks really that you're looking at. So you want to get sort of set out your universe and saying, right, what are the dominant themes in the market right now? All right, because the market is always trading a theme. There's always something happening. All right, at the moment, obviously, very obviously it's AI. But even within AI, there's been sort of like sub layers of AI where it was like the start of it was like, oh, it's NVIDIA. Everyone's going to need GPUs. And obviously everyone needed GPUs. And it was like, okay, now we need data centers to put all those GPUs in. Okay, well, let's bid all those up. What do we need to, we need power for those data centers. Right, well, let's bid up everything that provides power to data centers. Oh, what do we need now? Oh, we're going to have more agents. Right, well, that means we need more CPUs, so we need more chips, and that's where you've got your Intel and AMD, and all of the sort of, you know, the memory as well, obviously for agents, because they need the context for the AI models. So you're kind of, there's always like a theme that is dominating the market. And again, you don't need to go too far to find those themes a lot of the time. All right. But we've done a little webinar on this that's available on our what do you call it, on our Twitter feed. It's linked. I think I've sent you a link as well for you to have a little look at it. And that's just us talking about how themes tend to sort of arise, and they come from change. So you're always wanting to sort of look at the world and think, okay, what's changing? You know, what's changing in the world, and how long might that change last for? How meaningful might that change be to, you know, to how the world works? And obviously AI is, you know, a big structural change potentially that is going to change, you know, so many things. It's sort of akin to when the internet came. You know, I know a lot of people are like, oh, it's like the dot-com bubble and everything else, but it's like, it's not really, at least not yet. We haven't really done the whole bubble thing properly. Still plenty of time to do that if we want to. But there's sort of, you're looking at those themes to sort of see what's dominant and what's sort of coming in and out of focus. And then you're looking at those things and saying, okay, is the market still rewarding those themes? You know, what and where is the sort of attention shifting to alongside the narratives? And are you starting to see those narratives playing out on the charts? And you sort of, all you need to do that is to look at the stocks in terms of the groups, and kind of just understand the very basics of what each company does. Like, you know, like everyone knows, like ASML is like, if you're sort of in chips and you're sort of into tech, and again, a lot of these themes do play out in the tech sector because that tends to be where the most innovation and growth is. But like ASML's got a massive monopoly on these EUV machines that make, you know, a lot of the chips essentially, and it's like it's a massive monopoly. But they can sell off like you know, they sold off something like 40-50%. Was it about a year and a half ago? Not even 2 years, I don't think. And then all of a sudden, it's like it's rallied up and just kept on rallying and going and everything else, because all of a sudden people are like, oh, okay, we're going to need a lot more chips. So that means they're going to sell more machines. That change where we suddenly realize that and the market's paying attention to it means we're going to need more of those machines, which are very, very expensive. They've got the monopoly, therefore their share price should go higher. All right. And again, you start to see it play out on the chart. So you've got an idea, you've got a theory, you look at it and go, okay, the market's not paying attention to that right now. And then all of a sudden you start to notice that behavior change in that stock or in that sector or that group of stocks. And you pay attention to that and go, right, okay, so which is the stock that I want to back? Where do I want to put my capital? And you can make choices around that. You might want to sort of split your risk between, you know, 2 or 3 names, but you don't want to dilute yourself down too much, because then you might as well just buy the index if you start doing that. There's a lot of people that end up buying like 50 stocks and stuff like that. And you're like, you know, you haven't got enough size, you haven't got enough concentration to really benefit from the share price gains, because you've split your risk across too many things. You're too diversified. So you do need a bit of concentration in terms of the stocks that you're picking. Like I say, we tend to aim for about 10 for exactly that reason, because you're not too exposed to just one stock in terms of a risk management perspective, but you're also not, you know, you've got a meaningful amount of capital involved so that you can outperform the market and sort of generate some good returns. So that process is really just, it's a constant filtering process and just paying attention to, you know, what the market is rewarding at any given time and what the sort of the narrative is that is dominating everything. And it's just repeating that process all the time. And we tend to look at things like, you know, 3 years out, you know, try and imagine the future. What might it look like? You know, what might the next sort of phase of this be? And it's not that hard to kind of map out multiple scenarios. And then again, once you've got those scenarios planned out, much like we're looking at when we just sort of draw our lines on the charts, it's like, if this happens, then, you know, I'll do this. If that happens, then I'll do that. You know, it's like, really, if this happens, I'll buy this group of stocks. If that happens, I'll buy from this group of stocks. If this happens, then I'll buy from that group of stocks. And yeah, there's a lot of similarities in the kind of the overall, you know, between trading and trading everything else in the process of that, and kind of trying to look where the attention is and where price is moving. And it's just sort of, you're just adding on another layer of sort of understanding a little bit more about companies and businesses and really earnings growth and the potential for earnings growth, because obviously that is really the biggest driver of share price changes.
Are you trying to, so you'll see something that's hot at the moment, like you said, there'll be some sort of narrative that is basically hot topic everywhere. Are you kind of looking at that when everyone's talking about it? Okay, this is the time to get in, or is it's too much of a public thing? Like, what, if that makes sense?
No, I'm more looking at it through the screening process. So, you go on, like I say, we've got this kind of broad universe of stocks. There's like 800 and something stocks that are in that universe right now. Okay, so there's far too many to pay attention to at any given time. And a lot of the time, many of those stocks we wouldn't touch, all right, because they're just too boring. They don't move enough, but they give me a bit of perspective on what the market's doing, which is why they're in the universe. All right, but really we are, especially at the moment, it's very much focused on sort of the AI trade overall. But then I can give you an example of this. There was a company called Lumentum. All right, the ticker is Lite, LITE, and I had no idea what they did at all. But I sort of saw them popping up on the screener, and and again, it was just a really, really strong stock. And again, this tends to happen as well. It entered our universe by virtue of the share price growth and the market cap going up. So all of a sudden, I was like, oh, this one's new. What do they do? And their sort of whole thing is basically like optical connectivity. All right, so I kind of likened it to a lot of the connections in sort of data centers and chips and all of those things they're all done by copper wiring before. But obviously copper wiring is a bit like telecoms cables. Like you remember the old days when you used to have a modem and dial-up internet and all that crap, and everything went over phone lines, and it was all much, much slower. So it was the same problem that they had there with all of this stuff that's going on. It's like, well, hang on a minute. We've got all of this compute that we're sort of creating here, to serve these AI kind of overlords. But actually what we need to connect them together in a faster way. And it was like, Lumentum, among other companies, there's Corning as well. There was a few others. Like, I didn't know any of these companies before any of this. Didn't have a clue about any of them. But they all started popping up, and I was like, hang on, this is going to be a thing, because it just makes sense that you're going to want to have like those essentially fiber optic connections, like at a micro scale, between the data centers, within the chips, to get all of the data flowing faster, because that's just what you're going to need. That's the really obvious sort of next iteration of all of this. Like, why wouldn't that happen? And you're seeing it kind of appear, and then you're getting kind of confirmation from other similar stocks that also do the same thing, and you're like, right, okay, this is time. This is something here. And again, it's done. I think it did about 1,500%. That one, from when I first noticed it to when it sort of peaked out about 2 months ago.
So it's kind of like
it was 2 months. Yeah.
It's like, here's the shiny product, but here's all the elements that build that product, and that's where the real demand. Even though the product, you've got the demand for the product, you've got all the demands on the backside to create this product, and that's kind of where your main. Is that where your main focus is, or that's kind of like your starting point? Yeah. Okay.
Yeah, that's the main thing. So if you're looking for changes in demand, like there's been, I don't know how closely you follow it, but there's been a lot of talk about bottlenecks everywhere. Like there's a bottleneck in this, there's a bottleneck in that. Everything's a bottleneck now in the sort of AI trade, and really it's not a bottleneck. It's just that like there's a lot of demand, and they haven't been ready. Like no one saw it coming, so the capacity isn't there to supply that demand. So basic economics, supply and demand are out of line. What happens? Prices go up. So what they could charge before for essentially the same product, because there wasn't much demand for it. Obviously, the sort of the buyers had the upper hand, so they were sort of saying, no, I don't know if I want to pay that, because again, there wasn't the return on it for them either. They're not going to pay those prices. Then all of a sudden, everyone wants your product, and you basically create a bidding war for it. And also, they want more of it, so you're going to increase the amount that you are able to supply as well, because obviously you're getting more money in, so you want to increase your supply to meet that demand. Then obviously your earnings are going to go through the roof, because you're going to be selling more of it at a higher price.
Interesting. So in my head, there's two things or two approaches, which as I'm talking to you, are kind of which gels with me more. And the trader, like the day trader side of me, is thinking 1,500%. Like, oh my god, this is do I need to get involved where I'm like, let's see what stocks are in play on the day, and not have any sort of like marriage to a particular sector or a particular stock, and then just see where the momentum is and then ride it, versus what you're talking about is kind of gelling quite nicely, where it's find something that you can excuse me, get involved with, and then ride it for, without having too much input. It's kind of and have it, not in the background per se, but because obviously you still have maintenance and stuff, but where it doesn't require me to be like checking my phone every like 15-20 minutes to see what the hell's going on. And as I get older and I've got the kid and looking to add another one at some point, I realize how much time I'm wasting just like watching candles. As much as I love it, what you're saying is something it like deep in me going, yes, this is the way. This is like the better way to do things, right? This seems like not more fun because obviously you get feedback immediately as a day trader, but it seems like a big kind of puzzle that you're always working out and figuring out, I suppose. Is that kind of how you look at it too?
That's how I think of it, mate. That's how I think of it. Definitely. I mean, you might find as well that for you, you know, like personally, maybe the right approach might actually be a combination of approaches, whereby you might sort of say, you know what, actually, I'm going to sort of, you know, split my my focus between, you know, companies that I'm going to try and just sort of ride, and, you know, companies that I'm actually going to say, all right, I'm going to go for a 20%, 30% gain in this, and then I'm going to look for the next company that might do 20, 30%. Just based on, you know, different criteria that, you know, it's not necessarily in a trend, but maybe you can apply some similar kind of higher time frame principles of mean reversion from stocks that are particularly, you know, sort of oversold, shall we say, if to use a bit of a blanket cliched term. But you do get that, where you get certain stocks that are, they just sort of end up falling, and then they start to show a bit more positive action, you know. And even if it doesn't get into a trend, you can just say, you know what, I'm going to trade this back to the 200-day moving average, for example. You know, that was like Bitcoin was one a while ago when it had what was that, a couple of months back, I think it was, where it rallied back up to about, I think it was about 82k, and I was thinking it might make it back to that 200-day moving average, and it's sort of worth thinking of that as a bit of a target based on what I was sort of seeing. But it didn't make it back there, and that for me was the feedback there, where actually, you know, you want to be on the other side of it, because it couldn't even rally to the 200-day before it started to roll over. So, you know, you can apply those same principles in, you know, like I say, many stocks. And it might just be an idea of sort of saying, right, I'm going to pick, you know, 50 to 100 broad selection of stocks that I'm going to pay more attention to, that have all got sort of, you know, different profiles, but that you can kind of get to grips with their profiles and understand what they're doing and when, and kind of apply a sort of model to it and say, right, these are the kind of companies that I'm just going to try and trade. And then I'm also going to have a separate sort of process where I'm going to look for real growth companies, where I'm going to try and ride this out for as long as possible. And just that, so I'm going to put that, even have a separate account for it, maybe, just so you're not tempted to fiddle, and just maybe do that approach, you know, split your focus.
Yeah, I suppose it's just, when I'm thinking about it, I'm a kind of a visual learner. I'm kind of the type of person that just has to dive in and then like figure it out on the fly, and then get burned and get embarrassed, and then just pick myself up from mistakes. And it feels like that's kind of what I've got to be doing, really. Do you focus much on the indices as well, or is it mostly just stocks, the actual companies themselves?
Yeah, I mean, we do look at the indices, but mainly as a sort of as a broad based thing, because obviously it's very hard for, you know, most of the time, for kind of, shall we say, growth, you know, for a growth narrative to be taking place and being supported and bid up, if the indices aren't supporting it, you know, because obviously they're going to drag everything else down, generally speaking. Obviously, you can have a bit of an exception where, you know, obviously when things are trading weaker, you're going to get consumer staples, for example, as a kind of defensive stocks. They might outperform a bit, but again, they don't tend to have much volatility. So it's like, okay, do I really want to go and buy some of those and sort of try and eke out, you know, 10, 15, maybe 20% over a month or two while this, you know, this scenario plays out? And then maybe because I'm in those as well, and I'm kind of maybe too focused on what I'm holding, I might miss the opportunity on the other side, because I'm too focused on being defensive rather than being opportunistic, looking for the rebound. So generally, yeah, that's what we look at the indices for. You look at the indices just to kind of say, you know, is there a broad-based trend, especially in the tech sector, especially the NASDAQ, that we can kind of jump on board with, you know, and small caps to some extent as well. We've had a few small cap plays, and, you know, you look at the Russell and you want the Russell to be rallying alongside that as well. So sort of, you know, again, that you're seeing the money flow into the small cap space generally. You know, that can help. But mainly it's sort of, we do look at them, you know, it's NASDAQ and the S&P are the main sort of barometers that we're focused on. Because when volatility picks up in the S&P as well, you'll tend obviously to see, you know, things, you know, flip, and you'll see that, again, that behavior change quite often in how single stocks are behaving, because obviously everything's linked to the volatility of the index. So again, people have to de-risk when volatility picks up. So you're more likely to see negative action in single stocks when that's going on as well.
Okay. And when it comes to finding opportunities, obviously, like we said, there are narratives and there are very obvious things to like look for. Um, Is there, as time goes by and you're more experienced with this, do you find that you've got maybe a template for searching out opportunities, or maybe like some sort of process to that you can go, right, I'm done with this. This whole sector's dying now. Where am I moving to now? Have you got anything like that, or is that something that you just kind of develop with experience?
Yeah, no, I've got my screeners. My screeners are all set up for it, and again, it's sort of you're just looking for the changes in behaviour and seeing which stocks are sort of starting to lose their trends and which ones are starting to pick up. Like I say, we're seeing it at the moment right now. Where tech has been kind of wide and loose for about a month now. And we're sort of moving into July and hoping that tech is going to pick up. But as I'm sat here, the Nasdaq's below the 50-day moving average and looking kind of weak. You're seeing a lot of the hot names are being kind of wiped out. So in that scenario, you are kind of, at least for us, we're being more selective, and we're thinking about which stocks we really have that are for the long term, and which ones are more hype, shall we say, which are just sort of more pure momentum plays. And obviously, you want to be reducing more aggressively in the sort of the hype plays and the riskier names while that action's going on. But you don't want to be sort of rushing to sort of sell your Intel, for example. I think Intel can be a really good long-term business. Caterpillar, we're still involved in that and have been for a long, long time. I'm not going to rush off and sell Intel just because, the market's looking a little bit weak for a few days, or for a month even. It's just, there is a process to that. But there is a bit of discretion and experience that comes with it, I guess. But I think generally speaking, it is just it's the same things that I'm always looking at in terms of looking for opportunities and noticing the changes in the market. Like I've got my screeners set up for it for exactly that reason. And then I'm sort of filtering down, okay, which stocks are doing this, which stocks are doing that, which are strengthening, which are weakening, generally speaking. Do they align with a kind of a theme or kind of a group narrative? Is it more of a general broadening out in the market? Whereby, like I say, we've been very, very concentrated in tech in terms of the performance so far. But now we're seeing other groups starting to pick up. Software's sort of started to pick up as well, which, funny enough, has obviously been a bit aligned with Bitcoin at the same time. I don't know why those two have become correlated. I've got a suspicion that it's become part of a big long short trade, where everyone's been sort of long the chip stocks and short software and short Bitcoin and short crypto in general. All the while the AI is hot, obviously, and we've seen this with a lot of the former sort of crypto miners that had a load of GPUs that were sort of mining Bitcoin back in the day. They've kind of gone, oh, hang on a minute, we can make a load more money from AI, so we're going to become data centers. So they've gone off and done that, and obviously that's, I think, contributed to some of that kind of idea that all the while that AI is hot, crypto is weak, and people just tend to build up pairs trades on the back of that, where they're long something and they short something else. We've got to turn a light on. Hang on, there we go. Ooh. Blimey, right.
Well, hey, there we go.
Yeah, it's getting dark. I'm just
yeah.
looking at the screen. I just looked down and saw myself. I can barely see myself.
Yeah, I won't keep you too much longer, mate. My next question, really, on this before we do start to move on, because we are getting quite late now, is as a price action trader looking to move into this world, am I going to have to leave a portion of that behind and change my mindset to focus on different things in terms of how? Because I mean, we touched upon it before, like, oh, things look overextended, I've got to sell, or this chart looks like it's about to break out. Have I got to maybe park some of those ideas, or is that actually sort of key experience to help, or is it just part of the puzzle?
Yeah, I think it is part of the puzzle, but I do think you've got to sort of park some of it and sort of really focus on, is there a trend or not when it comes to stocks? Really sort of say, because sometimes what you'll see is you'll have like a market like a stock, for example, the typical kind of pin bar that you get at the highs in FX, that sort of hammer candle. And you'll see that and you go, all right, that's it. The top's in, I want to look for maybe a retest of that hammer, then I'm going to sell it and so on. But a lot of the time you don't get that in stocks. You just get, it's actually, because it's up near the highs, it's more likely to keep going higher, regardless of what that one day's price action looks like. So I do think you've got to kind of relegate it a little bit, shall we say, in the sort of decision stack. But overall, that sort of idea of price action in terms of breakouts and what you tend to see after breakouts, where you kind of get a breakout, maybe a bit of a a bit of a retest or a bit of a consolidation. It might come back into the range, and then obviously push on higher again. That kind of thing. That does happen. That does happen. But I think it's the mean reverting thing. I think is definitely the biggest hurdle that you have to overcome. The idea that it's gone up too much, or even gone down too much as well. If you're sort of, because a lot of the time you do see people get caught up in this trap of like, oh, it's so cheap. This stock's so cheap. I'm going to buy it because it's so cheap. Like it's cheap for a reason. Most of the time, it's like it's got a name. They're called value traps. Because they look like they're good value, but actually they're not growing. The market couldn't give two fucks about them, so no one's going to buy them. And you just need to, again, sort of say, right, I'm going to trust the trend. I'm going to trust that general trend of, higher or lower until proven otherwise, rather than trying to be a hero and saying, I'm going to call the lows, I'm going to call the highs, or whatever it might be. I think you just really have to focus much more on the trend as your main tool that you're using to sort of build everything else around.
Yeah, when I asked that before you answered, I was like, I think the answer is like what you're going to say is, yeah, you got to give that kind of like target driven mindset up, because conditions now, it's like I'm sort of brainwashed to thinking, oh, it's gone up, shit, it's going to come back right down, so I've got to protect my profits, right? I guess, yeah.
Yeah.
But again, like I said, it's just going to have to be something by trial by fire. Did you want to
Yes.
plug the Fink thing that you sent over? I'm going to put it in the description as well, or we can move on to the next section.
Yeah, I mean, it's just a webinar just explaining, what we touched on there with themes, and sort of trying to pick out themes and what they are, and how they sort of drive trends, basically. All right. So again, we're sort of always looking for that change in the world. We're looking for, something that might be a technological change. It might be a regulatory change. It might be a change in fiscal policy or fiscal sort of focus, or sovereignty, as it would be in the case of Trump, for example, where, we put out a few posts over the past couple of years where, literally the US government is telling you where to invest because they were. It's like, we're doing this with rare earths. Rare earths went crazy. We're doing this with drones. Drones went crazy. And it's been multiple times where you've had that. Because obviously they're sort of more focused on their sovereignty and trying to break the reliance on China and everything else. So and obviously that equates to change. So there's companies that, well, even the tariffs as well. Like Nike had all their factories and all their sort of everything they're doing was everything mainly in Vietnam. So there's huge amounts of sort of exposure to tariffs for those companies. So when tariffs came in, massive change for those companies. They were most affected, and obviously a company like Nike hasn't recovered from that, because there's a lot of other things they haven't been doing well for a while. So those things are always sort of in play, and that webinar just kind of gives a bit of an introduction to people of what we do, how we look at the market, and obviously we've got the academy that we use to sort of really broaden that out and give people a perspective on, a system and a better perspective on how these markets work. So you understand the system as well. It's not just here's a system, follow this blindly and you will make money, even though you could do it that way. But we want people to be independent and understand the principles of it as well.
Yeah, I think any time I've seen feedback about the Fink Academy, it's all been like massively positive, and I've always had that kind of FOMO, like I should get into this, and hence like we're getting this way. So I will put that in both the links in the description of the video, so anyone can go find that as well. Just to add, I didn't want to spend too long looking for that company because I thought it was quite rude while you were talking. I didn't want to like look for it. I'm going to try find it afterwards and I'll ping it to you on WhatsApp. But going back to what you said about how it was unusual that they released everything and the market opens, that was like the main appeal for like actually buying into it. But yeah, I'll find a company and I'll ping it over to you and see what you think afterwards. But we're getting quite late. I'm going to just very quickly run on to the next section, which is longevity in trading, longevity in investing, just longevity in this game in general, really, because it's very, very difficult. And as I had said earlier, I think you have to have that kind of 8 to 10 year mark before you understand like different market cycles. You've been exposed to different conditions multiple times. It's not just been like you're exposed to a bear market once and then you figure it out. You might have to go through 3 or 4 different bear markets of varying degrees to kind of understand it. Have you got any sort of thoughts on what has kept you going? Is it a passion? Is it, learning from your mistakes? Is it resilience to mistakes? Is there anything that you think, nearly 10 years or so, or plus 10 years that you've been in this now, where you think, right, this is the one thing that's kept me going all this time? And it's something which I think, when you've got exposure to traders that are learning and haven't gone through everything as much as you have, is there sort of something that sticks out that you go, right, this guy's got it, or this guy, like, he gets a little bit too emotional? Is there anything that you kind of, or any thoughts you have on this?
Yeah, I think I've got a lot of thoughts on it, but I won't go into everything. But I think resilience is the biggest thing. I definitely think that is something that you see with people that are going to make it. I think there's a kind of an inherent resilience, and I also think there's a resilience, a confidence, and a kind of permanent curiosity that I think are all sort of factors in, both for me, definitely. Like I didn't realize how resilient I was, to be honest. I didn't have any idea, but the fact that I'm still here has kind of proven it, I guess. It wasn't something that I ever thought about myself, but I guess in a way, it's sort of, I guess it could have been. Like I moved to another country when I was 19. And I just kind of jumped into a job, working in a bar. I didn't know the language, all that stuff. So and then I learned the language, worked in, estate agency, property development, everything else, ended up working at lawyers. So like I actually had a bit more resilience, I suppose, in that sense than I was aware of. But I'm certainly more aware of that now, having been through all of this. And I think there's just an acceptance of the games we're playing. That it's not really about you. I think is something that a lot of people take it very personally. Like they think they're on like some kind of hero's journey where they're going to beat the market and they're going to be like a legend and everyone's going to love them and tell them how wonderful they are, or all those extreme kind of ideas and sort of identities that people sort of impose on just sort of really a set of random outcomes from the market, which we all know that the market can be quite random, but you can stack the odds in your favor so that over time you can come out on top. But I think a lot of people, there's a kind of a real, they don't appreciate that randomness and they take it quite personally when it affects them badly. And that, I think, is that lack of appreciation for that and the game that we're playing, the fact that it is risk, and we're sort of trying to get the return, obviously, on the risks that we're taking. And again, the risks, that we're investing, one of the things that I'm big on is the fact, the time and effort. Like I'm saying to you about, and why David's sort of so big on saying to you, just stop trading FX, stop trading FX. It's like the time and effort that goes into it to extract some money for a relatively small move. When you could do something like just buy stocks and do nothing. It's like, okay, that's actually a much better return on what I'm investing in terms of my time, my sort of psychological toll, if you like. Time that I could be spending doing other things. It's potentially, I mean, for some people as well, it's maybe also time that they're not developing in any other way because they're just sat staring at a chart. So yeah, I think all of those things play out in many, many different ways. But I do think it's resilience and sort of that appreciation for simplicity being the key. Like our human operating system is just, we're not wired for this. I was talking, it's funny enough, today I was saying to you earlier, like where I've done boxing and Muay Thai over the past 9 months. That has been a real trial by fire as well. I've taken some fair old whacks while I've been learning that. And the trainer today, he was saying to one of the newer guys, like, this isn't natural. This isn't natural. Don't worry about it, because he kept flinching. He was jumping back too far. He was too reactionary, funny enough, and that's something obviously we don't want to be as traders and investors either. And he was saying that the fact that he was saying to me it's not natural, it just kind of, I thought it lined up perfectly with how I think about how our brains aren't wired for this and how they're also not wired for fighting and risk taking in general. We're not really wired by default for risk, most of us. Some people are, but they're in a minority. And I think sometimes those people are too wired for risk as well, and it kind of goes the other way.
Yeah, especially, I think the closer I'm getting to 40, I'm appreciating that some parts of trading are a young single man's game rather than.
Yes.
But like exactly what you said there, the amount of time and energy you can put into something that barely fucking moves to like and the stress that I'm putting myself under as a day trader. It's like, I'm just starting to think, like, as much as I love it when it's great, is it actually worth it to like palm off my son so I can just like watch some boxes and some candles move? And I'm just getting to a point now where it's like, I don't think so. I think as I've evolved as a trader, it feels to me like I've done a huge amount of work on like all different time frames and understanding price action and understanding how not only the price action but how narratives affect things and how different market participants and crowded trades and all this kind of stuff that you can think about. And I think that will serve me well for stocks, because now I can kind of take a step back, not take a step back, but I mean from the 1 minute time frame, I'm certainly taking a step back. But yeah, it certainly feels like a bit more of a slower pace, which I think is probably better suited to growth. And I guess it's a bit like golf, isn't it? To go into one of David's hobbies, I don't know if you play golf as well, but the idea of golf is to play as little golf as possible, isn't it? And I think that should be with trading, is you should do as little trading as possible to make as much money as possible. And I kind of feel like that's, as I'd said, like it's kind of feeling full circle, where all of the books that I read, they're all about stocks. And I used to sit there reading them going, I'm an FX trader. I don't really give a shit. Like, you're talking about stocks and all the jargon about stocks, and it doesn't feel relevant to me, but it feels like it's coming full circle. And it's like, this is really the direction that I feel is probably, I wouldn't say everyone has to go through, but it feels like the direction I certainly should be going to, whether it's I end up day trading it or swing trading it or just investing in it. And, you know, what you're doing at Fink, what you guys are doing over there, I think is really awesome, and something that I might actually end up gravitating towards as well. And that might be what I end up doing. But I think with certainly with regards to longevity in trading, I guess as well, you've got to kind of be open-minded and not rigid, because we don't operate within a rigid atmosphere and a rigid environment, do we really?
No, life happens all the time, you know. And again, mate, it flies by. Having kids, like, excuse me, mine now, all of a sudden I've got a 14-year-old and a 12-year-old. I don't know when that happened. It was like yesterday. They were tiny.
Yeah.
You know, all of a sudden they're like, 4 years time, the older one will be off to university.
Nuts, man. And yeah, that's the thing. Like, I look at my boy, it's bittersweet every day, and I'm like, oh, you stopped doing that thing you were doing just a couple of months ago because you're just growing. I remember, but he has got no concept of this thing it's, and I want to be around more for that. And I feel like stocks are like moving to stocks is probably going to be a really good switch.
Yeah, I'd say something.
But listen, Tim, thanks, man. This has been really educational, really awesome. I really enjoyed talking to you, and I hope we can get to this again at some point in the future.
Yeah, my pleasure.
So thank you very much for coming on. So just once again, I will put the Fink stuff in the description. But for anyone who is listening, like you, I first met David in 2018, and extremely smart guy, and in a world full of, like, I want to say LARPs and frauds and stuff, like David is like, and he stands out to me that he actually genuinely knows what he's doing, and the results that you got over there at Fink are, they say for themselves really what they are. They have been very good, and every time I see them, I'm like, I need to get involved. So I feel like now is going to be sort of the time I start to get involved. So thanks for explaining all of this, and thanks for being up late to do it for me. I really appreciate it, mate.
No problem at all, mate. My pleasure.